weekend. Ira Epstein of Linn Associates with your weekend edition of your agriculture wrap-up for the week ending April 17th, 2020. All right, my friends, and looking at the markets, I was waiting tonight to put out the update after hearing the president's press conference, and he did announce that there's going to be a $19 billion package for the farmers. Sonny Perdue, our ag secretary, came on. Didn't give me the specifics I wanted, but it's a pretty sizable package. It'll come out of the CCC, and now we'll find out where it goes and who it's going to help, how the payments are done, so on and so forth. Will the government be buying for our reserves any grains? It sounded like that. Is it going to be payments to the farmer of in-kind? I didn't get that out of it. So we'll see just what the government's going to do. Maybe they'll buy the food for the needy. I don't know how they're going to do all this. But in any case, as we take a look, you can see that at the end of the day, corn up a little bit and wheat. Beans, they've been under a tremendous amount of pressure and they stay there. The meat market, still the hogs, looking absolutely terrible on the weekly charts. Stock market came alive as we heard the three-phase plan, where a number of states are getting ready to, in some phase, enter that first phase. Now remember, to get to all three phases, in the best of scenarios, it's 6 weeks. So any way that you'd want to cut it, you're at June, right? Because here we are at the end of the second week or mid-April. So that's the best you're going to see, and those are for those states that are probably smaller. You know, you get to the New Yorks and Illinois and Michigan, I'd say that we're more towards July. What does that do for the summers? Can you imagine? But as we take a look, let's go to the charts, and remember, we're going to look at one monthly chart and then everything else is weekly. And what the market did is it hung in at this 18-month moving average in red. That's the MAC, moving average of closes, the 18-month. And it's broken down from there. We saw that on the daily charts, and you can see where you're coming. So how low can this market go is the question. Well, we've been under the $8 level. We got to the $7.97 level back here. Is that the test point we're going to make? Time will tell. On the weekly chart, as you can see what the market's been doing, it's rolling to the downside. The pattern is one of lower highs and lower lows. Now, we haven't gotten under this 820 level, but we're certainly honing in on that number, as you can see. If the market next week or the week after were to take out 870, I'd be able to then say, you probably got to a pattern where this is going to hold, at least as we get into the planting season and deal with the weather and so on. I'm not at that point. This is still a bearish look here. Where's the resistance in the market? Well, you can see the 100-week average in green, the 18-week. If you get a crossover is when a shorter-term average crosses over a longer term. If that 18 gets under that 100, traders that use moving averages should probably get another wave that they'll say is another wave of bearishness is coming. Let's assume you rally from here. That's still a formidable resistance area. What about support zones? Well, the Bollinger Band. I want you to look at that. And the top one. Number one, they're not parallel to the moving averages. They run on their own, and they're looking at its volatility, it's the size of ranges. But the way that they're interpreted is when you get down to them, it's a support level. Get up to them, it's a resistance level. My own teaching is that the first time you hit a Bollinger Band, especially if the pattern isn't one of real narrowness, it's wider, that is where I'm going to look for the first level of support. So this market hit these bands back here, rallied, hit the 100-day average, fell again, rallied back to the 18 and the 100-day. Now they're falling. You know what I'm going to say? If the market hits that 827 3/4, I'm looking for the pros to take off their shorts against that number. The low this week, 831 3/4. Momentum. On the weekly charts, I don't look at overbought or oversold. The market's either pointing up in momentum, down, or flat. Momentum is still pointing down. So the bias is down since the close of the markets under the 18-week average. The swing line is down as you've got lower highs and lower lows. Possibility of support 827 3/4. In the meal market, You had tried to stay over that upper Bollinger Band, and now it's a failure. Why do I call it a failure now? This is how the market looked as it came back to challenge that 18-week average. When a market tries a breakout, if it's going to go for it again, it should not take out wherever that swing line low is. So that would be the number I'm looking at. I think the bulls probably tried to defend the position because they had higher lows and higher highs, and this threw them out of their trade. That's what I think happened last week, and you followed through with more people probably getting out of the market now. Are we trending? The answer is no. You have a higher high, a lower low. A downtrend is lower highs, lower lows. The bias is down, and momentum is still pointing to the downside. In the oil, you've been in a downtrend. Now remember, there's a crush spread that you always look at. You take a soybean, you crush it. Are you going to use the meal more? Are you going to use the oil? Which one has a demand? If there's no demand for anything, why crush the soybean? Keep it in the farmer's bin or in the elevator. But when you do the crush, you've got lower highs, lower lows. This market's been in a steady downtrend. Unlike the meal that got over that 18-week average, this did not. Momentum is still to the down. Bias is down, trend is down. If the market let go to the downside, I'd look for this. Now, that's the 2377. Last week's low in this market was 2620. This week's low is 2623. It did not have an outside week down. So if the market rallied and didn't take out this low, until you get over 2973, you're still in a basically bearish trend. So something that I'm looking at there. Frankly, as I'm looking at this, I put that arrow. I should have left it up there. I would have left it to the down had it been an outside week, so I erred on that. In the corn market, this is called running the Bollinger Band. And what happens is you get under it, you come back over it, you get under it, you come back over it. It's a sign of extreme weakness. When the market can't even bounce back into the range on the other side of it, it's like glue. It's stuck there, and that's where we're at in this market. Now, could it be that what the president announced with Sonny Perdue helps this? I don't know. I don't know the specifics of the program. But this looks bad, and to make matters worse, planting season's going on. You're going to get more crop. Where are we putting all this crop? Who's going to buy it? Are you telling me China's going to? That'd be great. But they lost their hog herd, right? A big part. Let's assume they lost 40 to 60%. I hear numbers all over the board. Well, that's a lot of animal feed. What are you doing there? Then in America, we're culling chickens. We can't get our animals to be bought by the slaughterhouses because of the COVID-19. Grain, there's plenty of it. That's my point. Wheat market. Wheat market entered a new bear phase. Lower highs, lower lows. Admittedly, it is stuck between the upper Bollinger Band and the lower. So it's a whipsaw market. The bears grabbed control this week. This is when they broke through that low. And that could put in play here the lower Bollinger Band of 516 to the 100-week average 510. I would expect short covering to come in there. And you throw this pattern out if you take out this week's high, and that was 564.5. The sugar is still very much in a bear pattern. You have the lower highs, lower lows. Now, why is sugar so bearish? Well, a big part of it is it's used for ethanol. And who's driving anywhere in the world? That becomes a big issue. And Brazil's one of the major producers. We look at that. We look at our own sugar. Nobody eats sugar per se. Don't get me wrong, it's in a lot of food, but nobody's promoting that you eat a lot of sugar. In the coffee, well, they're opening 300 Starbucks now in America, I hear. It's coming right up maybe as early as the end of the month. So that's a sign of something somewhere trying to get somewhat back to normal. I don't know where they're located. We'll find out. I haven't seen it because I don't see any of the states that are allowing people to go out to do that. But I read that, and I hope it's America that I heard. I think it was. But higher lows, higher highs, hanging in here at the 18-day average. So on the weekly charts, the bulls are controlling the market. You're over the 18-week average. You have higher lows, higher highs. Momentum trying to go sideways. You turn bearish on this market if you take out 112.40. That would give you lower highs, lower lows, and potentially put in for a challenge possibly of the 105.50 level. So I think the bulls have to defend themselves right here. Cotton is still bearish. lower highs, lower lows. Now what we did have for a while is you had gotten here under the Bollinger Band this week and that week, and now you popped back over it. Remember, I said 5% of the time you stay under it. My rule of thumb work is, each consecutive week under it, I subtract one of those percentage points. So we ended up, if I'm correct on what I'm reading here, where the market, let's see, this week, where did it close? I just want to be certain of what I'm saying. 53.68. So that week was under it. This week was 60.49, just over it. So I had 1, 2, 3 weeks in a row under it. That gave me basically a 96%, not even that, about a 97% chance, each one's a percentage point, that the market would come back to the right-hand side. That's how I count it. Market bounced back. Now the market is still very much in the bear play. It just moved to the right-hand side, and it's all systems still bearish on it until they're not bearish on it. In the cattle market, a bounce in a bear market. But remember, you had a bearish crossover here where the 18-week average got under the 100-week, and you can see where that crossover occurred this week. And let's see if I can there we go. So this rally has got an awful lot of resistance, and this number is going to come racing down now to come into these zones here. But I see resistance above the market, momentum down, trend still down in the cattle. In the hog market, a new low for the move. And as you can see, you've got a pattern with an outside week down this week that until this week's highs taken up, be it this coming week or the week after, I think the bears have control, and the number that they don't want to see taken out is this week's high of 46.05. Barring that, things look to me still very much in the bear camp. In the mornings, what I start my traders off with is the first thing in the morning. I'm talking, I'm up at 4:30. I'm reading, and by 5:30, 5:45, I'm already recording for you a video. Now, I'm not in that video. I'd be ugly at that hour. I have to do myself up. But I've got a professional studio here in the house, and I'm recording for you the charts. And the charts are going to cover 40 markets, all futures markets for you, and it's going to cover the grains, the meat markets, the soft markets, right on through everything that you can imagine. And I make it fairly easy. I'm going to talk with you if there's any fundamentals. Do we have any crop production reports, pig crop, cattle reports coming up? I'll talk to you if there's something going on in the world and weather situations in different parts. So I get your day going with it. That's the idea that I'm trying to do. Then I'm going to cover all these markets in this exact sequence. There's a slide bar on the bottom, and as you pull it, it's going to light up and say meats, grains. Go right to the section you want. If you don't want to see the financial part, you don't have to. It's pretty simple. The average video in the morning is about, and I'm giving you about 20 minutes long. So I'm not racing through things. I'm trying to teach, and it's not like this. There's a lot more oomph in it. $7.95 for 30 days. We're all locked in the house. Come on, give it a try. See what you like. And if you're a SPDR or ETF video person, you'll see that I do one very similar, the subscriber video for that. How do you get to it? Go to our website. Go to the word research. As soon as you click that area, you'll see the drop down. Just sign up right there. We'll have you on the list immediately. And we also do make available to you our handheld app. All the quotes, the news of the day, everything's coming through there. Charts that you can put studies on if you want to. If you have a trading account with us, you trade right through it. And my videos, they'll come up with a push notification, no text. You're not going to pay for that. A push notification, just hit it and the videos play as they come out. I'm Ira. You have a great weekend, and I will see you all come Monday.